We have countries that are negotiating in good faith, but they should be aware that if we can't get across the line because they are being recalcitrant, then we could spring back to the April 2nd levels. I hope that won't have to happen.
Treasury Secretary Scott Bessent warning trading partners of higher tariffs after July 9th if deals can't be reached. And President Trump is already turning up the heat on Japan, threatening new levies for not buying more American rice. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into those headlines with crucial context and sharp analysis. Asian shares edge up, but Japan slips as Trump's tariff clock ticks. The dollar posting its worst first half since 1973.
The president sent this note to the Fed chair. It says, Jerome, you are as usual too late. You have cost the USA a fortune and continue to do so. You should lower the rate by a lot. Hundreds of billions of dollars are being lost and there is no inflation.
The president keeps pressing Fed Chair Powell to lower U.S. interest rates. Well, Goldman now sees a rate cut in September as tariff inflation fears ease. Schroders' Joanna Kyrklund will tell us where to find resilience, risk and returns in a world of rising uncertainty over global trade and interest rates. And later, India's former UN envoy, Syed Akbaruddin, on the high-stakes U.S. trade talks and what could still derail a deal. You're with Insight. Now let's get to the latest on progress in trade talks with President Trump's July 9 tariffs deadline ticking ever closer. Trump is now threatening to impose a fresh tariff level on Japan over the country's unwillingness to take U.S. rice exports. In a social media post, the president says he may instead send Japan a letter. That's a reference to promises in recent weeks to cut off difficult talks and instead simply inform countries of their higher tariff rates. Japan's Chief Cabinet Secretary Yoshimasa Hayashi declined comment on rice, but said Tokyo won't sacrifice agriculture in trade talks. As for the EU, sources say the bloc is willing to accept a 10% universal tariff on exports, but wants the US to commit to lower rates on key sectors as well. This includes quotas and exemptions to effectively lower a 25% tariff on autos and car parts, as well as a 50% tariff on steel as well as aluminum. Treasury Secretary Scott Bessent says U.S. trade negotiators are amazed at the kinds of offers they're getting from other countries as the July 9th tariff deadline looms. Bessent told us more about what to expect as talks enter the final stretch.
There's going to be a flurry going into the final week as the pressure increases.
What can you tell us about what's coming out of those deals? Are they inked deals or are they negotiations for future deals?
Well, what I can tell you is that the staff level, whether it's at Treasury, at USTR, at Commerce, people who've been around for 20 years are in amazement, and they're saying these countries are coming with offers that they can't believe. So in terms of bringing down tariffs, non-tariff trade barriers, we're leaving aside currency, the financing of the labor and capital in an advantageous way. All these countries are pulling back.
So you've said that trade negotiations could be wrapped up by Labor Day. How should investors and nations impacted be thinking about that July 9th deadline? And could that be pushed back to avoid going back to those April 2nd tariff rates?
Well, that's going to be up to President Trump. And I'm not going to tell any country. We have countries that are negotiating in good faith, but they should be aware that if we can't get across the line because they are being recalcitrant, then we could spring back to the April 2nd levels. I hope that won't have to happen. We have seen no inflation from tariffs. if we do, which we don't have to, then there'd be a one-time price adjustment. Nothing is more transitory than that. So, Team Transitory, having failed the American people in 22, they seem a little frozen at the wheel here.
And that was U.S. Treasury Secretary Scott Bessent speaking to Bloomberg. The optimism surrounding trade deals helped lift U.S. stocks to fresh all-time highs, yet the euphoria is being tempered in Asia after Trump's latest tariff threat. Avril Hong, as always, is here. Avril, what's the market really pricing in? Progress on trade or just relief that things aren't getting worse?
I mean, if you look at how the region's benchmark has not just moved off those April lows, it clocked gains of about 12% for the quarter, highest in September 2021. It does add to the sense of expectations of real progress on the trade deals, but there seems to be a more nuanced picture emerging between the US and Japanese sides, this gulf among the negotiators. If you take a look, though, about the US policy-making uncertainties, that also seems to have prompted this rethink and optimism towards Asia stocks, especially when they can demonstrate, these Asia companies, resilience. You think about the Japanese Tankan report. Among large manufacturers, there was a surprise pickup in sentiment, even amid the tariff uncertainties. For South Korea stocks, there's expectations, given how things are still cheap, despite not being as cheap as before, that the bull market can continue even into this quarter. That being said, for the region's benchmark, the third quarter in the past 5 years has typically averaged declines of about 1%, so we are in a sort of soft patch, seasonally speaking. Now, flip the board. Let's take a look at the US stock performance. It rallied to all-time highs. We saw it being driven by tech. This was a lot of the trade deal optimism, but if you unpack things a little, you're seeing the breadth actually not very wide. So maybe this speaks to the sense among investors, they're not terribly convinced that this rally is sustainable. You think about the softness in consumer spending, that seems to be fading, losing momentum a little. And then among US companies, if their pricing power starts to be lagging compared to the cost increases, that could also mean more earnings downgrades. That could stall the rally. Now flip the board, take a look at what we're seeing on the dollar, because of course it's been in focus. We've seen the Bloomberg dollar index experiencing its worst first half since 2005. If you look at the narrower US dollar gauge, that's the worst since the 1970s, partly to do with expectations that the Fed resumes rate cuts, some say July, but also these concerns about the US fiscal trajectory, debt, concerns about Trump's tariff agenda and what this is going to mean longer term for the structure of the global economy.
That's right. We saw the Taiwan dollar inching higher, 12% year to date. Wow, quite a big headache for the central bank. Avril Hong, thank you so much for that. Let's get perspective from Joanna Kyrklund, Group Chief Investment Officer at Global Asset and Wealth Manager Schroders. Joanna, good to have you with us. Let's start with the dollar. Interesting, 11% upside year to date. What the steepest decline since in 50 years, and the losses are expected to continue.
Yeah, I mean, generally, we also expect the dollar to remain weak. Now, I don't think that's a short-term call. In the short term, it can always fluctuate. But big picture, what's happening is I think that asset owners around the world are reconsidering what the optimal dollar allocation is. And after many years where dollar assets have done very well, the dollar's been a great hedge when markets have gone down and also been exposed you to some great US assets. I think typically people are finding their US dollar allocations are a bit too high. Doesn't mean that they're abandoning the US, they're just thinking, hang on a minute, we need to diversify a little bit. And I think that's quite a profound shift.
Not abandoning the US, but US exceptionalism, the theme at least, is easing, correct?
Yes.
And how do you square that? We have a dollar that's weakening in a huge way, yet we have the S&P trading at record highs.
Yes, because I think that there are a number of things at play here. First of all, the US tech story is still holding up, and that's obviously a big driver of the S&P 500. And actually for US equities, a weaker dollar is not necessarily a bad thing. It boosts overseas earnings. So for an equity market, a weaker currency is not necessarily a challenge. I think the bond market is being protected by the fact that Bessent has made it clear that the stability of the bond market is key. So if you remember, there was a moment where Trump kind of roiled the bond market a couple of months ago, and Bessent stepped in. So I think that has been helpful to the US bond market. And for now, inflation's still under control. So for now, we're seeing a decoupling between the performance of US assets and the performance of the US dollar.
Let's unpick some of that. You talked about how mega tech in the US still the place to be in a way. And you hold some of those big plays, tech plays in the US. How much higher can they go? I mean, when you take a look at valuations, where are they? Are you comfortable where they are?
No, again, I mean, we own select names there. For me, that's very much a stock pickers game. But of course, we have AI is also a big theme. And obviously, some of those names are playing big in that space. So we still like US tech, but I think compared to the last decade, when I always said US was reassuringly expensive in a world where growth was very weak, the fact that you had the superior earnings coming out of the US justified higher valuations. We're in a very different market regime now. It's more inflationary, there's more nominal growth going around, major shifts in spending, not just in the US, but also in Europe. And as a consequence, we do think that there's great opportunities outside the US as well.
You like the AI theme, but aren't you playing AI differently, especially on the back of DeepSeek?
Well, I think that DeepSeek was an important moment because it showed that innovation does not only reside in the US. Coming back to US exceptionalism, I think, dare I say it, maybe there's a bit of arrogance on that, that the idea that all the innovation was coming out of the US, that proved that innovation obviously is also coming out of China. So I think that was an important moment. But ultimately, in terms of the way that we're benefiting from that theme, it is still very much through the US tech sector. So as I said, it's really about diversification. That's what's happening. It's not people jettisoning US assets. It's more people rebalancing their portfolios, recognizing the level of concentration in US assets had got too high.
How does that diversification look like in a global portfolio? How has that changed in the last 4 or 5 months?
So what we've seen is quite a lot of demand for European assets in particular. So European bonds are definitely seeing interest. We're seeing that on our own platform. And I think, again, that speaks, nobody's weaponizing their bond exposures. It's just people saying, at the margin, can I diversify my risk a little bit? And I think European equities has also been a great story this year. We still like European equities. If you look at European banks in recent years, they've actually kept up with the Mag 7. Nobody seems to talk about that. But the return, the shift from negative yields to positive yields in Europe is a profound shift, particularly for the financial sector. So that's really, I think Europe has been the main beneficiary.
And of course, we've seen the euro benefiting from that. And some are saying that perhaps we're not even halfway, the upside of euro dollar. I mean, how are you looking at it? Where is it headed?
So we still like the euro against the dollar. Generally, we like European assets. And again, it's about that diversification story. You don't have to believe terrible things about the US to expect the US dollar to weaken. It's true, right? I think it's a good adjustment. So yes, I think that there is potential. And generally, we're quite positive still on markets. I don't know if you want to talk about that, but obviously there is a lot of uncertainty. I think every day you wake up to new headlines from Trump. But big picture, actually, I think Trump is very symptomatic of a more profound shift in the policy consensus in the West towards greater fiscal spending. Yes, some anti-globalization, more protectionism. But actually, ultimately, this boosts nominal growth, which does help equity markets. And the key is, as long as the bond market can take it, I think we're okay.
We talk to a lot of investors who feel like there's so much uncertainty that it is tempting to just sit on your hands and wait for greater clarity. But you say you can price those uncertainties. How so? And how have you played that in the market?
So the first thing to say is, look, I've been doing this job for 28 years, and it's never felt easy. I've never woken up saying it's obvious what to do. So I think ultimately
it's much worse now than before.
I'm not sure, because I think that, for example, in the last decade, when we were facing negative yields in Europe and zero rates, although the system felt stable, actually that was profoundly wrong, right? It's not good to have zero rates. It's not good to have negative yields. How do you price anything? So although it felt stable, I think actually I was more worried back then because we were buying ever more expensive assets. There has been a repricing. Fixed income's looking much more attractive than it used to. That's a major shift since 2022. So actually, in some cases, valuations are attractive. Outside the US, equity valuations are still fine. And again, there is more growth. In the last decade, the main challenge we had was a lack of growth. And now we're seeing stronger growth. The key thing we have to watch every single day is whether the bond market's stable, because you're seeing much more fiscal spending, not just in the US, but in Europe. Think about all the elections we had last year. Nobody was arguing for fiscal rectitude. So that's what we need to watch. And for now, the bond market's behaving itself.
So 60-40 still intact?
I think so.
And
yes.
that's the way to go in terms of getting the best returns?
I think you also need to consider, we've liked gold. Yes, it's gone up a long way, but it's a good hedge against these debt dynamics that we're seeing. So again, we think that gold is a useful diversifier. and also looking for alternative sources of yield. So generally, I think diversification is a really important thing. Thinking about geographical diversification, your currency risk, considering some alternative assets. But yes, I don't think there's anything wrong with 60-40. People go on about the fact that 60-40 benefited from the negative correlation between equities and bonds. But when 60-40 was first invented, the two asset classes were positively correlated. You owned bonds for income and equities for growth. And that's exactly the case for it today.
How does Asia fit into your global portfolio?
So again, I mean, we see great opportunities in Asia. I think often when people look at index level, they're missing the fact that there's some great companies in the region. So generally, as you probably know, we're big managers of Asian equity. Yes. Again, valuations are attractive in the region.
Where especially?
Generally, I think when we look at China, we find stocks we like. I think at index level, it's hard to take a view. There's still some challenges there. But from a stock perspective, there's some great companies in China, so we still see opportunities from the bottom up in China, even if index level, maybe things aren't as attractive. Obviously, Taiwan and Korea are central to the tech story, which is something that we still believe in globally. The AI disruption is very real. And then ultimately, we're looking at markets like Australia and Singapore for great yielding companies. The impact of the dividend yield in this region, some great companies delivering very solid total returns when you take into account the dividend, I think is often underestimated. So again, we see opportunities across the region.
When it comes to China, how did it go from being uninvestable to, you seeing lots of potential? I mean, what changed?
We've always been committed to China. So I think the key thing was that maybe a minor shift, well, quite a significant shift at the beginning of this year was a couple of years ago, we started to have to cope with quite a lot of political risk at stock level. Some of the sectors were getting regulated in new ways, and that created a lot of uncertainty at stock level. This year, we've seen a more supportive stance from the government towards the tech sector, for example, and I think that has helped to bring the risk premium down in China a little bit.
A lot of sentiment has been driven by stimulus.
Yeah.
And how big that stimulus is. Does it matter if you don't see more stimulus from China to boost the economy and perhaps prop up some of the industries?
I think that buying China on the stimulus news is tough because ultimately there's still overcapacity in the property sector. We have seen a resurgence of animal spirits in the economy, which is helpful, but I wouldn't be betting on some huge resurgence in Chinese consumption. I think for me it's still about finding the innovation. China is still a great market to find very innovative stocks. In some sense it's the only market that really competes with the United States on this front.
Just one final question. You talk about how you can price risk, you can price the uncertainties. What's the biggest risk you see out there for the markets for the rest of the year?
Coming back to this issue with we need the bond market to be stable. Populist policies are okay because they boost nominal growth as long as the bond market can take it. We've obviously seen a steepening of the yield curve, which we need to keep an eye on. I'm concerned about the credibility of the Fed being undermined. So that's the kind of thing that we need to watch. Ultimately is where institutions, the credibility of institutions are being undermined, then potentially we have a problem for the bond market. So, when I see that letter, that note to Powell, I do find that a little bit of a concern. That's the thing. So it doesn't capture the headlines in quite the same way. But in this environment, the key thing is the credibility of institutions.
Independence.
Independence is important, yeah.
Thank you so much for that. Joanna Kyrklund, Group Chief Investment Officer at Schroders. Still ahead this hour, we'll speak with a former Indian envoy to the United Nations as New Delhi negotiates with the US ahead of the July 9th tariff deadline. Syed Akbaruddin will be joining us live in a few minutes. Keep it here with us. This is Bloomberg. Welcome back to Insight. Let's do a check on Treasuries. The Treasury market posting its best monthly performance since February. We have yields pretty much falling across the curve. Traders focusing on the upcoming jobs report on Thursday and, of course, that potential Fed interest rate cuts. Investors increasingly confident about at least 2 rate cuts by the end of the year. Some expecting a cut as early as July, despite the Fed officials favoring pretty much a wait and see move. The US dollar currently about down by about 0.1%, extending the declines that we've been seeing of late. Now, with global investors growing uneasy about U.S. assets, Korea's $200 billion sovereign wealth fund is making a bold bet, is doubling down on North America with more than 60% of its holdings now in the region. In an exclusive interview, Korea Investment Corporation CEO Park Il-young tells us why U.S. Treasuries are still at the heart of that strategy.
We are happy to the investment in the U.S. Treasury in a sense that the U.S. Treasury bond gives a very strong liquidity and stable returns, and also regardless of any short-term market volatilities, we are expecting the stable and the solid returns in the short term. So for the time being, we maintain our portfolio, the Treasury bond as the core portfolios. But in the longer term, we are mindful of any risks from the supply change from the investors, and also some policy uncertainties.
Long term, do you need to be rethinking that? How are you looking at your exposure to U.S. Treasuries longer term, and how are you looking at potential alternatives to U.S. Treasury? Are there alternatives?
We are now reconsidering our asset allocation. We understand our long term the returns are largely depend on our asset allocation. So among the fixed income investment, we are also interested in investing the credit, and credit bonds and other structural bonds, along with the U.S. Treasury, and also more fundamentally we are now considering to our asset allocation between the fixed income, the global equity.
Do you see alternatives to public fixed income? And would you be looking to increase your weighting into things like private credit, for example, and private lending? And what role do you see that part playing in your portfolio?
Actually, we just start with the investment in fixed income in 20 years ago. Now we diversified our portfolio to the alternative investment, including, as you said, private equity, and real estate, private credit, and the infrastructure. So we believe the alternative investment will be our core asset in our portfolio in the longer term. So we plan to invest continuously, very and steadily pace.
Coming up, we'll discuss what's at stake as the U.S. and India inch closer to a trade deal. Former Indian envoy to the UN, Syed Akbaruddin, will be joining us next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on Japanese assets coming back online after the lunch break. Traders there are weighing President Trump's threat to impose a fresh tariff level due to Tokyo's unwillingness to accept U.S. rice exports. We're also monitoring the Indian rupee after the White House hinted at further progress in trade talks with New Delhi.
They are finalizing these agreements, and you'll hear from the president and his team, his trade team, very soon when it comes to India. India remains a very strategic ally in the Asia Pacific, and the president has a very good relationship with Prime Minister Modi, as you know, and he will continue to have that.
For more, let's bring in our Bloomberg government editor, John Huskowitz in Tokyo. John, it does seem like Japan is at risk of getting trade talks cut short and receiving that letter from Trump instead.
Yeah, things are looking difficult for reaching some sort of deal by the July 9th deadline. There are stumbling blocks on rice, as you mentioned, and also the main thing is the auto sector. The sectoral tariff of 25% that's imposed on car makers is really affecting Japan. Japan is looking for some sort of comprehensive deal, and it's getting difficult to find. So reaching some sort of agreement by July 9th doesn't look like it's going to happen. And also, Japan is having difficulty negotiating with the Trump administration, it appears. The goalposts seem to be shifting. One other thing to take into consideration with rice is that it's an important issue for the base of the ruling Liberal Democratic Party, which is facing elections in the upper house in July. Making too many concessions could hurt it at the polls and could hurt its political standings. So quite a bit going on with Japan and the U.S. with the rice, auto sector, and also its domestic politics.
Japan's having talks with other countries as well. What's the status of that, including with India?
The India talks are also hitting a hurdle. India was supposed to be one of the first to reach a deal. In fact, when Modi visited Trump in February, being one of the first leaders to go to the White House after Trump returned, they were looking at a trade deal, hoping to get the first section in line by fall. So things started even before the tariff threats came on, and now it's looking difficult. I think India is balking at U.S. demands to accept genetically modified food products, and prospects for a deal are not as good as they once were, even though this was one of the first that the Trump administration touted that it saw as coming to some sort of fruition.
John, thank you so much for that. Bloomberg government editor John Hertzkovitz there. Let's bring in our guest. Syed Akbaruddin is Dean of Kautilya School of Public Policy and a former Indian envoy to the United Nations. Mr. Akbaruddin, good to have you with us. You said before that nothing riles Indians more than the idea that the Indian government is getting bullied by a foreign leader or foreign government. How are you analyzing the dynamics in these trade talks between the U.S. and India?
So, first of all, thank you very much, Haslinda, for having me on your show. That said, India was initially amongst the first countries to set off on a trade deal. They have a rather ambitious agreement between Trump and Prime Minister Modi about 500 million by 2030 in terms of bilateral trade. It's around 200 million right now. So, and they also thought they'll have an early harvest by autumn when Trump is set to visit India for the Quad summit. That said, things have changed since February. We now have multiple elements in a trade negotiation, which has made it more complex. We have reciprocal tariffs. We have sectoral tariffs. So the Indian negotiators are right now in Washington. The Indian government hopes to have a beautiful big deal, but there are challenges, as was mentioned, in terms of agriculture, in terms of dairy products, because India has never had any trade agreement which covers these two areas, and of course genetically modified fruit, but the primary challenges are in terms of dairy and agricultural products.
So it's challenging, it is complicated, yet we've heard a lot of optimism from the likes of Vice President J.D. Vance, also from Howard Lutnick. I'm just wondering whether that optimism is misplaced, or is there reason to think we will see a deal before the deadline?
So the deadline is only for the reciprocal tariffs, which is 26% in India's case. Yes, there is a lot of optimism in the Indian side too that they will make it. There's hard negotiations going on, and it's good to have people posture. The challenge, of course, for the Indian side is not to give up too much right now, because trade deals always have an impact on the population. We don't have many elections in India this year, so that's a saving grace. There's only one election coming up in November. So this is perhaps the best time for the Modi government to go in for reform, go in for a trade deal, a big, beautiful trade deal, if I were to use President Trump's word. And I think there is a lot of optimism in India that it will pull through despite difficulties. And if you won't have a full-fledged thing right now, they'll look for early harvest in October, November. So what they're looking right now is to try and see whether the reciprocal tariffs are off the table and that there is no further change in the sectoral tariffs, because President Trump has the habit of bringing in new tariffs. For example, there are sectoral tariffs on automobiles, there are sectoral tariffs on iron and steel. So I think the negotiations now are that once this deal is done, there won't be any further tariffs on the table until the early harvest in October, November.
As you suggested, Trump has indicated it is a test of reciprocity. It does seem, though, to a lot of people that India seems to be making more concessions than the U.S. Is that your own impression as well?
Sure, that's bound to happen because there is a feeling in India, too, that the tariff rates were higher than elsewhere. We've had these challenges with other countries, too. So it's not that it's new to India that there is this pressure on India to reduce tariffs. And as India integrates with the world, this is bound to come down. It's good for the world, but it's also good for India. There's a thinking in India that it's going to be difficult, but that's part of the restructuring as India gets integrated to a greater degree in the world. After all, if it's going to be the fourth largest economy by the end of this year, it has to learn to deal with engagement with the world. And trade is always give and take. There will be some gives and some takes. But the longer term belief is that India is on a growth path and these will help it. So there's a general belief that despite the difficult choices, we will come through and the future holds something much better than what the past held for us.
Is it getting more complicated because of what Trump has been saying, that the U.S. played a big role in the ceasefire between India as well as Pakistan?
Yes, that's a strange issue because he's said almost 20 times now that India has, or he's played a role in preventing a nuclear catastrophe in the in India and Pakistan, and he said that he's used the trade lever. Now, this is a challenge in multiple ways for India. Because India is very prickly. It does not countenance a third-party interference, as we say, in terms of our bilateral ties with Pakistan. Also, it's a challenge that if you accept that trade can be a lever, that means it will always be used as a lever against India, which wants a balanced partnership with the US. And finally, the Indian contention is that you're equating the victim of terrorism, that is India, with the perpetrator of terrorism, which is state-sponsored terrorism from Pakistan. So for all these reasons, it's unnecessarily complicated, which is an issue which is already fairly complex and difficult. And I see no reason why this was done, and it's been repeated. It just adds to the difficulties at arriving at a mutually suitable agreement. But I think that's what it is. And the Indian negotiators are trying to work this through. It's a difficult situation, but they're confident that they'll get through.
Mr. Akbaruddin, when we talk trade, we talk supply chains. We know that India produces the iPhones, but most of the components actually come from overseas. We know India is trying to source its components locally. There's a plan for that. Do you see sometime down the road that perhaps, the more it seizes the supply chain, the more in trouble it would get with the U.S.?
Yes, this is the new challenge, which again wasn't there on the table at the beginning of the year. In the beginning, we were hearing about friendshoring, nearshoring, etc. But now Trump says onshoring and nothing else. And so this is a challenge because I think Apple's taken a strategic decision to move part of their production capacities to India. They hope that in the near future, they will have about 25% of iPhones manufactured in India. So this is also one of the give and take in this bigger picture, that India feels that if we are to concede on agriculture, if we are to work out mutually acceptable deals on dairy, then there shouldn't be any more new surprises in terms of tariffs, because iPhone production has now gathered pace in India. It's about 15% of the global production is from India. Recently, much of the exports to US of iPhones are from India. And India's invested a lot. There are subsidies in this. There is a whole ecosystem being built. And we hope that that is not yanked off the table. So part of this deal, which makes it more complex, is also to ensure that once we agree to a trade arrangement, telecom equipment, automobiles equipment, all these will not be off the table, because this is where India sees that it can surge ahead.
Relationships are being reassessed under the Trump administration. Do you see India pivoting more towards Europe or even traditional allies like Russia on the back of that?
So diversification is the name of the game these days. Everybody is promiscuous in their relationships. So you have India would like to have a relationship with the US, which keeps growing because it's easily one of our most significant relationships. Having said that, I think in a world which is tumultuous, it's always good to have backup and have ties which are diversified, so that if there are any challenges in one relationship, you can bank on the other. So India has also started a discussion with the EU to have a free trade agreement before the end of the year. We are also looking at our long-established ties with Russia, where trade has surged, primarily because of challenges with Russian exports to the West. And so these are all situations of balancing out. Diversification is no longer a theoretical thing. It's something in practice, and that's what everybody does. The USA does it. It wants good relations with China. It wants good relations with Japan. It also wants good relations with India and Europe. So we are in a flux. So everybody is hedging. Everybody is diversifying. And so is India.
Mr. Akbaruddin, we thank you so much for your assessment today. Syed Akbaruddin, Dean of Kautilya School of Public Policy and a former Indian envoy to the United Nations. Well, China's manufacturing activity rebounded in June, according to a private survey suggesting relief after the trade war truce with the U.S. Let's bring in our China correspondent, Min Lo in Hong Kong. Min, I mean, this is showing a divergent reading from the official PMI that came out yesterday. What does it really tell us?
Yes, the official PMI tends to cover upstream sectors and the state-owned enterprises, while the private survey tend to capture the export-oriented firms. So we did see the Caixin survey today beating expectations by a pretty wide margin, coming in expansion at 50.4 versus the official manufacturing PMI, which was in contraction at 49.7. But both readings, regardless, had beaten analysts' expectations, at least the median forecast. And it shows you that perhaps, especially the exporters, they are less gloomy than before, riding on that temporary truce that China and US had reached back in May. But you look at some of the sub-indexes, though, you still see prices falling, manufacturers slashing prices to remain competitive, the sub-index for employment contracting as well. So still some weakness that remain. And I think the big question is whether the front loading will be able to sustain, and we could see a payback period in the second half of the year. There's still a lack of clarity about that tariff level beyond the August deadline. I think both sides, US and China, have not been very explicit about whether the tariff will remain the same beyond August, whether that was part of the trade agreement that they had both signed.
And meantime, China's Foreign Minister Wang Yi, he's begun his week-long trip to Europe. What's on his agenda?
Yeah, so Wang Yi is going to be in Brussels. He will be in Germany, in France as well. And he's preparing for this upcoming EU-China summit that is set to take place at the second half of July. And there are a lot of issues for both sides to tackle. And top of mind for the EU is rare earths export, because the EU has been caught in this crosshair between China and the US. And when China required these permits for export of rare earths, we saw those export levels plummeting across the board, including to the EU. And this next chart shows you exports falling by 81% in May. So this is top of mind. And you add to that the trade imbalance, because China's trade surplus with the EU had risen dramatically this year, hitting a record high in the first 5 months of the year. Again, it's that impact of the US-China tariff war, because these Chinese exporters are now looking for alternative markets. And where are they looking? They're looking at open economies, rich economies, and the EU is the top destination there. So this is going to be another sort of sticking point between the two sides. Of course, other historical issues that Ursula von der Leyen has been very outspoken about, including what she calls the China shock, how China has been dumping its overcapacity problem on the EU and weaponizing its dominance over certain materials to undermine overseas competitors. There is the tariffs on Chinese EVs, the restrictions on Chinese medical devices. Of course, China has retaliated with these probes into European pork and brandy. China has delayed the outcomes of these probes as a gesture of goodwill, but also keeping those as leverage if the talks don't go well.
The big question is really, how do they stabilize their relationship as they look to diversify those relationships and trade ties? That's right. So China is now trying to really on this offensive to try to beef up its relations with other parts of the world. And again, you look at, for example, how the yuan has been performing against the euro. The euro is at its strongest point against the yuan since 2014. And it's a dollar softness story, but the yuan at the same time has not risen as much as its peers, whether you compare it to Asian currencies or EM currencies. It shows you that PBOC has been carefully managing the strength of the yuan to give a boost to Chinese exports. Whether or not this will become an issue between EU and China, that's going to be the big question. But we are seeing that continued slow pace in the strength of the yuan. That's something that we'll be keeping an eye on as well. Min, thank you so much for that. Bloomberg's China correspondent Min Lo. Coming up, Apple said to be considering using OpenAI or Anthropic to power Siri as it struggles with generative AI continues. Details of our scoop next. Keep it here with us. This is Bloomberg. Welcome back to Inside. Bloomberg has learned that Apple is considering using AI from the likes of Anthropic or OpenAI to power a new version of Siri. Shares rose on the report as the tech giant looks to turn around its struggling in-house AI efforts. And here's a look at how some of Asia's top Apple suppliers are trading today on the news. They're all trending up. We have Hon Hai currently up by almost 3%. For more, let's bring in our Tech Asia co-anchor, Annabelle Drules. And Belle, I mean, using a third-party AI model, that's pretty unusual. That's quite a turnaround for Apple.
Yeah, because we know that Apple in general really likes to do everything in-house. But at the same time, Apple has very much the perception within the tech industry that it's behind on its AI efforts. Because, for instance, we had the delays to Apple Intelligence being rolled out and certainly a lot of different roadblocks or stumbling blocks that it faced as well. So they're really going back to basics here and thinking, what can we do exactly to turn this around and make us a market leader? So to that end, what we're understanding from people that are familiar with this and the AI team is that they're looking at using third-party models. And so far, those discussions, as you said, they seem to be possibly Anthropic and OpenAI. And what they're asking them to do is to train their models that could run on Apple's cloud infrastructure. So that would be sort of a testing phase. Now, if they move ahead with this, of course, it's a really big question mark. We do understand, again, from our sources that Apple is just operating with a high degree of uncertainty and a lack of clarity as to which way they're exactly going to move forward.
I know that the whole idea is still in its infancy, early days yet, but you got to wonder, what's the impact on Apple's own AI team?
Yeah, this has been another really interesting sort of thread that has come out of these conversations is sort of the perception of how this could be perceived. I mean, I do think we need to make clear that the licensing third-party technology is certainly going to mirror moves that we've seen from Samsung, for instance, that's using Gemini's technology. Anthropic, for instance, is used by Amazon for Alexa Plus. So there's sort of a precedent there. But as for what it indicates to Apple and to the team, the AI team at Apple, I mean, we're hearing that they're going to be feeling a little bit sort of overlooked in this efforts, and also that need to bring in a third party could also reflect poorly on them. So the question, of course, is exactly what they do, especially when you've got the likes of Meta that's really building out its AI efforts and is offering possibly very large financial incentives as well for people to join.
And speaking of Meta, Bell, we know that it is restructuring its new AI effort. Tell us more about that.
Yeah, this is a really interesting development we had. So Mark Zuckerberg has essentially announced a restructuring of the company's artificial intelligence teams or group, and it's going to be committed to what's called superintelligence. So just to give the details on that, right now we operate in a world of AI, and you're talking about chatbots, for instance. We're looking ahead to what could be AGI, or artificial general intelligence. And so this is a point that many say could be even decades away, maybe even impossible. But AGI is when you have AI that has cognitive abilities that are on a par with humans. Then you move to ASI, or what's known as what artificial superintelligence is known as, but that is when AI has cognitive abilities that exceed that of a human, and that includes both on an IQ basis but also an EQ basis. And so that is going to be something that Meta is working toward, and the restructuring of this is going to be led by a man called Alexander Wang. He's the former CEO of the data labeling startup Scale AI. But under Wang's leadership, they're going to be, again, very much focused on ASI moving forward.
And of course, that means a lot of money, right? Hundreds of billions of dollars, Bell.
Yeah, that's right. And to going back to that point around how much they're putting into this, I mean, Zuckerberg has said that they do plan to spend hundreds of billions of dollars on AI projects and research in the years to come. And that reference back to who they could be looking to hire from. I mean, we've already seen people from OpenAI moving ship. The question, do we start to see people from Apple, for instance, if they do proceed with taking on third-party company technology? But essentially, they're spending big on this. They've already hired 11 new researchers and engineers from companies like OpenAI, Anthropic and Google under this new team called MSL, or Meta Superintelligence.
Annabelle Drulis, thank you so much for that. A quick programming note before we go. You can see live coverage of our major monetary policy panel later today from the ECB Forum in Portugal. That will be moderated by Bloomberg TV's Francine Lacroix, 9:30 p.m. if you're in Hong Kong. And tomorrow on Insight, Lefa Tegla Investment CEO will be joining us. That's it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.